to business. In this chapter, we're going to be taking a look at economics, which are considered the framework for business. As we go through this chapter, we'll be defining economics and discuss the evolving global economic crisis. We'll look at the impact of fiscal and monetary policy on the economy, explain and evaluate the free market system and supply and demand. We'll also look at and evaluate planned market systems. We'll describe the trend towards mixed market systems. And finally, we'll discuss key terms and tools to evaluate economic performance. So economics involves studying the choices that are made in allocating resources. It is divided into two categories, macroeconomics and microeconomics. The economy is a financial and social system, and it represents the flow of resources through society, from production to distribution to consumption. Macroeconomics directly affects day-to-day life, influencing things like what jobs will be available for people, how much salary an employee will take home after his or her taxes are deducted, and so on. Microeconomics deals with individual consumers, families, and businesses. Both macroeconomics and microeconomics played an integral role in the global economic crisis that we're just now moving out of. So the stock market dropped and unemployment rose when the dot-com business fell. The situation worsened after the 9/11 terrorist attacks. In an effort to avert recession by increasing the money supply and encouraging investment, the Federal Reserve decreased interest rates from 6.5% in mid-2000 to 1.25% by the end of 2002. Although the economy received a lot of money, the opportunities to invest were not that great. Subprime mortgages, mortgage loans came into play, attracting borrowers and lenders alike. Borrowers found it easy to get subprime mortgage loans, and lenders started giving loans without verifying documents. Demand for and prices of homes continued to rise. Borrowers started taking adjustable rate loans. Well, when that happened, subprime lenders got higher returns. And with a lack of reservation, financial institutions didn't maintain sufficient reserves. In 2006, housing prices peaked and then fell steeply. A majority of the subprime borrowers owed more money to their lenders than the value of their homes. Borrowers couldn't refinance to lower their payments. Foreclosure rates initially climbed and then fell and continued falling. As mortgage values dropped, many institutions started collapsing. Banks didn't lend money to clients, and funds were not available for businesses, and many businesses had to let go of their employees. In October 2008, Congress passed the $700 billion TARP, which is the Troubled Assets Relief Program. By the end of the year, the Treasury had spent half of the money investing in banks. The Treasury also spent a portion of the money in a partial bailout of the auto industry. Now, the Fed can help shape the economic performance of the country. So the fiscal and monetary policy can help achieve controlled, sustained, and economic growth. Fiscal strategies have a connection with the political philosophy that the Feds employ. Most economists say that lowering the taxes can help in economic growth because people will have more money to spend or invest. And the Federal Reserve is in charge of the U.S. monetary policy. Now, a debt ceiling makes up being about The debt ceiling ends up being about whether or not the federal government can pay for the debt that it has already incurred. Typically, debt ceiling increases are low-key affairs, but in 2011, the increase garnered unprecedented political and journalistic attention. After weeks of thinking, Congress agreed to increase the debt ceiling. Excuse me. Although this temporarily avoided a shutdown crisis, it created the fiscal cliff, which could dramatically decrease the U.S. budget deficit. Going over the fiscal cliff could potentially cripple the U.S. economy and possibly even cause the U.S. to default on some of its debt, which could send world markets into a tailspin. So when the Congress could not reach a reasonable long-term agreement, they simply passed last-minute legislation that pushed the really tough tax and spending decisions farther down the road till the U.S. hits the debt ceiling again in mid-February of 2013. Now, every year the government must create a budget or a financial plan that outlines expected revenue from taxes and fees and expected spending. If income is more than expenditure, the government incurs a budget surplus. On the other hand, a budget deficit is created if income is less than expenditure. In the case of a budget deficit, the government has to borrow money, and the sum of all the money borrowed over the years and not yet repaid is known as the federal debt. Now, the Federal Reserve Bank is controlled by a 7-member Board of Governors. The members of the board are appointed by the president. They serve a 14-year term, and the terms expire every 2 years. And what this means is that no single president will appoint all the members of the Board of Governors. The president appoints one of the members to serve as its chairman. Now, the Federal Reserve Banks are owned by member commercial banks in their individual districts. In addition to setting monetary policy, the Board of Governors oversees the operation of the 12 Federal Reserve Banks that carry out Fed policies and perform banking services for commercial banks in their districts. Now, the core purpose of the Fed is to influence the size of the money supply, or the total amount of money within the overall economy. The most common definitions of money supply are M1 and M2. M1 refers to all currencies plus checking accounts and traveler's checks. M2 refers to all currencies, which is M1, plus checking accounts and traveler's checks, plus most savings accounts, money market accounts, and certificates of deposit. In December 2012, the M1 was 2.5 trillion and M2 was 10.5 trillion. If there is more money, interest rates tend to fall. And this is especially true when the economy contracts. This encourages businesses to grow and consumers to spend. If there is less money, interest rates rise. This reduces spending, and it also helps to keep inflation in check. The Fed uses open market operations, discount rate changes, and reserve requirement changes to contract the money supply. Open market operations. The Fed mostly uses the open market operations. Treasury bonds, notes, and bills are the IOUs the government issues to finance its deficit spending. When the economy is facing a downfall, the Fed buys government securities on the open market. When inflation is a concern, the Fed sells securities. Open market operations are regulated by the Federal Open Market Committee. The committee consists of the 7 members of the Board of Governors and 5 of the 12 presidents of the Federal Reserve District Banks. In 1930 and 1931, many banks failed. The FDIC, or Federal Deposit Insurance Corporation, was established by Congress in 1933 to rebuild people's confidence in the banking system. And it also ensures your money that is held in your savings accounts and your checking accounts up to $250,000 per customer. Commercial banks are allowed to borrow money from the Fed. The interest rate the Fed charges for such loans is known as the discount rate. If the Fed decreases the discount rate, it becomes easier for the banks to take out loans at a lower cost. This also reduces the rates on bank loans, thus stimulating the economy as people are more likely to borrow money and spend it too. The Fed makes it mandatory for all its member banks to hold reserve funds. The reserve requirement benefits those depositors who want to borrow money without notice. Currently, the reserve requirement is 10%, depending on the size and type of a bank's deposits. Over time and around the globe, nations have instituted different economic systems, but a careful analysis suggests that no system is perfect, which may explain why there isn't one standard approach. The United States follows the capitalistic economic system. The core capitalist principle is the paramount importance of individuals, innovation, and hard work. In such a system, individuals, businesses, or nonprofit organizations privately own the vast majority of enterprises. These private sector businesses are free to make their own choices regarding everything, and individuals are free to choose what they purchase. In this system, companies must offer value